My name's Dave McCary with McCary Wealth Management. I'll be doing a series of webinars in the weeks and months ahead that will focus on different case studies that help explain what I do for my clients in my wealth management practice. But I'd like to start by giving you a little background on who I am and what sets me apart from other advisors in the wealth management industry. I was born, fortunately or unfortunately, depending how you look at it, into a family of some wealth. My great-great-grandfather was Eberhard Anheuser, founder of Anheuser-Busch, which is the beer company in St. Louis. And because of that, I've spent a good part of my adult life actually managing my family's wealth for the last 20 years or so and helping my family craft a multi-generational wealth transfer estate. The lessons I've learned over the last 20 years have been significant. And it's those lessons, those high points, those low points and struggles that I can share with my clients and often help them avoid a number of the potholes that I've experienced with my family. The areas that my wealth management firm works in are 5: estate planning, retirement planning, insurance review, investment review, and tax planning. And over the next few weeks and months, I'll be doing case studies in each of those areas. Let's dive into this case study. This is a retirement planning case study where I help my client, John and Jane Anderson, figure out their retirement years, what they can do with their investment portfolio, how much they might be able to sell their family business for, how that will contribute to supporting them and their children and grandchildren in the future. And we can model all of this on a retirement planning tool that I use. And let's look at this family. They are a fictitious family, John and Jane Anderson. They're in their early 60s, both of them. They hope to retire in a year. They've got 3 adult children, 2 of them married, and each of the married children have 1 child. Their net worth, as you can see, is $15.7 million. They've got investable stocks and bonds currently of $2.1 million. So the bulk of their net worth is in the value of their family business, which is valued at about $10 million. Valuing a privately owned family company can be difficult, and you'll see how that works into our planning analysis. This tool that I use is a forward projecting tool to help us estimate what the future retirement might look like for John and Jane. So let's go ahead and go to the planning tool and let's take a look at John and Jane's future. Now, this tool shows John and Jane and me the balance in their investment portfolio over time into the future. It starts this year and it goes out until their end of life, which will be at about age 100. What you see here is their current investment portfolio at $2.3 million, and they retire in 2024 at that orange icon, and then they will pass in 2059 at age 100. So currently, if they were to retire as planned next year and use their investment portfolio to support their lifestyle, they would run out of money very quickly, actually, by 2036. But there's a lot more to their plan than their current portfolio value. And that's because they have a home that they could downsize and net another $1.5 million they could put into their investment portfolio. They have a business to sell, and we're not sure what the final sale price is, so we'll put in 3 possible selling prices: 10 million, 9 million, and 8 million, and we'll look to see how those various selling prices impact their future retirement. So the goal here is to get these bars, which represent the balance in their investment portfolios, to extend all the way out to their retirement. So let's see how we can get that to start to work. If they sell their home and bring in another $1.5 million into their investment portfolios, which I can help them manage, you'll see they've extended the life of their portfolios out to 2044. So that's good. But it's still not getting them where they need to get, which is all the way out to retirement. Right now, they've run out of money. So let's sell their business. And let's sell it for what they hope to get, which is $10 million. And they would sell that business next year. Now, they've put $10 million after taxes and brokerage fees to sell the business into their investment portfolios. And as you can see, they are drastically improved in their future retirement outlook. Let's go from future dollars to today's dollars so that we don't have to try to figure out inflation. Now, that's good news for them. Now they want to know, how much can they give to their kids every year in the form of gifting? And that, by doing that, it reduces their taxable estate at the time that they pass and reduces estate taxes paid to the government. They like to give annually to their kids $40,000. They can comfortably do that. You saw the bars moved only a little. They like to give to charity $50,000 a year. Watch what happens. Again, the bars move down just a little. They can very much do that. Let's say they want to give $100,000 to charity every year. They can still do that. The bars shrank a bit, but they still have at the end 11 million and 7. Let's double check the bottom here. 9 million 9 of value gained, and 11 million 7 is the value at the end. What if they want to give another 50,000 to charity? They can do that and still not outlive their money. The next consideration is this cash flow assumes what's called a straight line market for every year. The exact same return on the portfolio every single year. Well, we know that's not true. We know that's not the way the markets actually work. So this tool allows us to adjust this projection as though there's a real market moving out there. So this will do 1,000 market trials, and we'll pick the middle trial, not the best, not the worst, the one in the middle. And we can see that the portfolio assets end up at $7.9 million in their last year with these assumptions on the left. But what if the market does worse than a middle return over these remaining years? What if it's, say, in the bottom 20% performance? Well, they're still okay. They're ending up with $3.9 million after gifting $150,000 a year to charity and $40,000 a year to their kids. So that's good. But what if they can't sell their business for $10 million? What if they can only sell their business for $9 million? So we'll back out the 10, and then we'll add 9 instead of 10 to the investment portfolio that they will live on. They didn't quite make it, did they? They run out of money just a couple of years before they pass at the 20% conservative future market return scenario. Well, what if the market was in the middle? What if the performance of the market was a middle performance? They just make it. So now we can I can help the client actually get a sense of what their future might look like at various market performance levels. Let's look at if they sell the business not for $9 million, but for $8 million. So they just barely squeak by at the 50% market return. If it's a more conservative 20% scenario, they run out of money. So let's say they really won't get more than $8 million for their business. Then they'll need to back off giving to charity. Instead of giving 150, maybe they give 100. And by doing so, they just squeak in at the end. Maybe they choose to only give $50,000 a year to charity. Any money left in their portfolio when they pass will go to their kids and grandkids. So in this scenario, in a 20%, a bottom 20% market return scenario, they end up with $1.8 million, which would then pass to their kids and grandkids. Maybe that's what they're comfortable with. But this tool is a wonderful way to help them figure out these types of scenarios. I hope you've enjoyed this case study, and I look forward to seeing you on the next case. I hope you enjoy these videos, and if you have questions, you can always contact me by going to my website. Simply Google Anheuser Advisor. That's ANHEUSER. Thanks for your time.